A game-changer strategy that separates the winners from the rest. The Smart Money Concept's continuation entry model. How many times have you missed out on perfect trading opportunities due to unpredictable market behavior? It's a common scenario. Market can turn ultra-volatile when you're eyeing that perfect entry point, leaving you without an opportunity. Or perhaps you've missed a trade because life called and you weren't by your screens when the price hit your entry mark. In this episode, we'll show you how to turn those missed opportunities into successful trades. Plus, we'll break down the essential criteria and rules that distinguish a winning trade from the rest. So traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. See you after intro. Welcome back, traders. So let's get started. As you are likely aware, the market is drawn to a lot of liquidity, which results in constant volatility and continuous oscillations. It's a common scenario where traders miss out on excellent trading opportunities solely due to market behavior. For example, the market can become highly volatile when the price approaches their desired entry point, often failing to provide a suitable entry opportunity for them. Alternatively, traders may miss a trade because they are away from their screens when the price reaches their intended entry point. Interestingly, the price mitigates their recognized supply or demand zone and then proceeds in the direction they had anticipated. This raises an important question. What should we do when faced with situations like these? The solution is straightforward. We must utilize the Smart Money Concept's continuation entry strategy to enter the market and execute trades. Now let's delve into the details of SMC's continuation trading strategy and explore the essential criteria and rules of this entry model that we need to consider before executing a trade with a high probability of success. If you miss the change of character or flip pattern, or if the price action doesn't provide an opportunity to enter the market, then taking the continuation trade becomes the easiest and safest way to execute trades. Imagine we have a bullish structure on the 15-minute time frame in which we're conducting our market analysis. That price has created a series of break of structures to the upside. And if we look at the most recent BOS, we see that price has formed a perfect unmitigated demand zone just located at the extreme, with inefficiency placed above. Next, what we do is zoom in on a lower time frame, for example, the 1-minute time frame. We wait for the price to touch the unmitigated demand zone from the higher time frame, experience a reversal, and then form a change of character or flip pattern, indicating a shift in market structure. As seen here, the price has created a change of character pattern and created a new demand zone in the 1-minute time frame, attributed to the bullish wave of the change of character. With the emergence of the change of character pattern, we understand that it signals a loss of control by sellers, and we can anticipate a bullish order flow to the upside. Therefore, we should explore potential opportunities to enter the market by opening long positions. Now let's say you somehow miss this entry opportunity during the change of character, or you simply want to open additional long positions. Price. After the mitigation of the demand zone, it reversed and shifted its character to the upside by breaking and closing above these structures and breaking through several supply zones. If you couldn't execute any long positions from the change of character supply zone, in such a scenario, the recommended approach is to use SMC's continuation strategy to enter the market. To achieve this, the price needs to break the recent structure to the upside and pass through this 1-minute supply zone, creating a newly generated supply zone. In this case, I wouldn't recommend placing any limit order at this newly generated demand zone due to potential risk. There's still a high probability that the price could use this demand zone as an inducement to generate more liquidity. Therefore, it's advisable to wait for the price to form liquidity zones and sweep them before tapping into our newly recognized demand zone. But before we continue, if you're curious about how we stay updated on financial news and fundamental analysis, well, what we're looking for here is a pullback after breaking the recent structure and forming a liquidity zone, such as double bottoms, triple bottoms, or trendline liquidity above the new demand zone. It doesn't matter whether the price pushes to the upside and creates a new break of structure or remains choppy for a while. After the creation of the liquidity zones above the demand zone, we can now set a limit order in the demand zone. This is because we have a very strong confirmation factor if the price sweeps the liquidity zones that form above the demand zone before tapping into it. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial. This pattern confirms the strength of our supply or demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. Market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. To execute a trade based on the SMC continuation entry model, there are 4 essential criteria to consider. The first rule requires the price to form a change of character pattern or flip pattern after reaching the higher time frame supply or demand zone. Subsequently, we must patiently await a break of structure and a zone breakout in the price movement. The third rule emphasizes that the price should have left inefficiency behind when forming a break of structure. The last and most crucial rule is the presence of static liquidity zones near our identified point of interest. In summary, to have an opportunity to execute continuation trades, it's essential that all of these rules and criteria are met, and there are no exceptions. Here, all the mentioned criteria are met. Next, we place our buy limit order at the highest point of the demand zone, with the stop loss a few pips below the lowest point of the area. For the take profit, the target is the swing high at the extreme. The continuation entry model allows us to execute multiple trades simultaneously in the market's dominant direction. For example, each time a point of interest is created that meets all the previously mentioned criteria, this strategy can be employed for trade execution. However, it's vital to consider some key points to prevent significant losses and ensure high probability trades, which we'll elaborate on in detail on the next topic. In the following, we can see that the price has once again created a new break of structure and has already broken through the next supply zone, leaving inefficiency behind. Thus, we have another unmitigated demand zone in the 1-minute time frame. Additionally, we can see that the price formed a bullish trendline liquidity above our newly identified demand zone. Retail traders who rely on trend lines and chart patterns enter the market every time the price touches the trend line, placing their stop losses just below it. This approach results in the formation of a substantial liquidity pool positioned just below the trend line, waiting to be cleared by the market. Consequently, numerous stop losses are closely aligned with the trend line and are positioned by retail traders. In this scenario, it's highly likely that the price will push back down to clear the liquidity below the trend line, triggering the stop losses of retail traders. It aims to fill the inefficiency left behind and then tap into the demand zone situated at the extreme. With all the criteria of the continuation entry model met, we can now place our buy limit order at the highest point of the order block and set the swing high as our take profit target. To execute multiple trades simultaneously, there are certain points and rules you must consider. Limit the number of open positions to a maximum of 3 at the same time. Always remember that the position size you risk for the first entry should be halved for the next upcoming trades. For example, if your first position size is 2 lots, it's advisable to risk half that amount, which is 1 lot, for the subsequent trades. Now let's proceed to the real chart and see trading example. Here, we have the 15-minute chart of the euro-dollar on the screen. As you can see, the price is in an uptrend and has also created bullish breaks of structure to the upside. If we look at the most recent break of structure, we can see that the price has formed a perfect demand zone with inefficiency placed at its top. As we can see in the following, the price has retraced, entered a pullback phase, filled the inefficiency left behind, and reached our identified demand zone where it experienced rejection. Now, our next step is to zoom into the lower time frame, in this case the 1-minute time frame, to gain a clearer view of the price action and search for possible trading opportunities. Now let's take a closer look at it. Here on the 1-minute time frame, we can see that price was in a temporary downtrend until it reached the 15-minute time frame's demand zone. After reaching this zone, the price reversed, moved to the upside, broke the previous structure, and formed a valid change of character. Following the formation of the change of character pattern, we can see that the price entered a pullback phase, moved back down, and after mitigating the bullish order block generated by the Chach's wave, it pushed to the upside. Now let's consider a scenario where we missed the change of character entry. As the price has shown a market structure shift, we are now looking to utilize the SMC continuation entry model to execute trades. Now let's see what happens with the price action. As you can see, after mitigating the change of character's demand zone, the price rapidly pushed to the upside with significant inefficiency, creating two successive bullish breaks of structures. Additionally, the price broke out of this 1-minute time frame supply zone. Next, we identify the demand zone associated with the recent bullish wave. We can already identify an equal low just above our point of interest, creating a substantial liquidity pool waiting to be swept. As we mentioned before, to execute a trade based on the SMC continuation entry model, there are 4 essential criteria to consider. The first rule is that the price must form a change of character. And as you can see here, the price has done that. The next criterion is that the price must break structures and also break through supplies or demand zones. And yes, we can see it on the chart. The third rule emphasizes that the price should have left inefficiency behind when forming a break of structure. It's clear that we have it here. The fourth and last rule is that the price must form liquidity zones near the identified point of interest, which has already been met here. Now that all criteria have been met, we can go ahead and place a buy limit order at our identified point of interest, with the stop loss a few pips below our zone. For the take profit, I'm going to target the swing high. Now that we have placed our buy limit order, let's see how the market reacts and see if our trade setup plays out successfully. As you can see in the following, the price pushed to the downside, swept the liquidity accumulated below the equal lows, and after mitigating our point of interest and also activating the buy limit order, reversed its direction and moved upward. Now, we can see that the price has created another bullish break of structure with inefficiency. It broke through these supply zones. Also, price formed a trendline liquidity above this new demand zone, which is generated by the bullish break of structure. Once again, if all the criteria are met and we are allowed to execute another long position, there are additional rules to consider. Avoid executing more than 3 trades at the same time. For the second and third orders, it's advisable to use half the size of the first position that was executed earlier. Now in the next step, I'm going to place a buy limit order at the highest point of this order block with the half size of the order that I executed earlier. And for the take profit, I am aiming for the upper 15-minute time frame swing high. Now we must monitor the market closely and let the trade unfold according to our analysis. Our sell order has been activated, and we are officially in the market. As anticipated, the price moved upside after the activation of our last buy limit order. Eventually, both trades hit the take profit target. That's it, traders. Thank you for watching this video.